This is Open Work, a look inside the watch industry, a podcast from Collective Horology. I'm Asher Rapkin, co-founder of Collective.
And I'm Gabe Riley, co-founder of Collective.
Collective Horology is an independent watch retailer based in Southern California. We carry a wide range of independent brands, including Garrick, Zeitwinkel, Chapek, and more. To learn more about us and check out our available inventory, visit collectivehorology.com.
Hey, Asher, speaking of collectivehorology.com, did you know that we just implemented the number one most requested feature from customers on Collective Horology in the history of the website and the business?
Free watches?
Well, I mean, sort of. So we actually just rolled out buy now and pay over time from Affirm. So if that's something that you guys have been interested in, go check it out. It is now available on the site. And seriously, this is the thing we have been asked for more than anything by customers over time. So happy to say that that is now available.
We should also point out that the next episode of this podcast will be live from Geneva Watch Days.
Live?
So, live. And by live, I mean you will hear it after we've recorded it. But it may be on a slightly different day than our normal release. So keep an eye on Instagram to find out when that drops.
Today on the podcast, we're taking a deep dive into the current state of the secondary or pre-owned watch market with our good friend Hamza Masood of Watch Charts, the world's most comprehensive, transparent, and trusted source of watch market data. It's a service that we at Collective subscribe to for its valuable insight, not just into the pre-owned watch market, but what that data can tell us about the watch industry at large. And that's exactly what we're going to discuss today with Hamza. What exactly is going on in the pre-owned watch market? And more importantly, what does it tell us about the industry at large? And of course, the implications for collectors. Now, Hamza, I think I've met you in person a number of times. We've hung out a couple of times, but I first came across you on episode 245 of the Worn and Wound podcast, which was not just a masterclass on watch charts. So if anyone wants to know about like watch charts and how they do what they do and everything about watch charts, listen to that podcast. But what was most interesting to me about that podcast was when you talked about your collecting philosophy and your collection. And it is hands down probably the most interesting podcast I've ever heard about a particular collector, their approach to watch collecting, and the watches in their collection. So anyone who is listening, don't stop now listening to this podcast, but as soon as you're done, check out episode 245 of the Worn and Wound podcast. That was a really great one.
Thank you. That's very kind of you to say.
Welcome to Open Work.
Thank you. Thanks for having me.
I guess before we get into what exactly is going on in the secondary watch market, we're going to talk about a bunch of your, not just data, but really the insights and the learnings, the implications behind it. But I guess the first question for you and about watch charts most generally is, why focus on the secondary watch market? What does that data really tell us, and what's the value of it?
Right. So there's a few different ways that I can answer that question. But even before I get into answering that question, just sort of a segue from the shout out to the Worn and Wound podcast episode. I collect watches. I'm a watch enthusiast. That's why I do this as my full-time job. But when I'm thinking about sort of like when I have my professional cap on, it's very different from when I have my like collector or enthusiast cap on. So the things that I collect are not necessarily informed by any like crazy insights that I have into the market. The things that I am interested in buying, the next like 3 or 4 watches on my wish list, like there's nothing that we do that gives me any crazy insight into like now is the right time to buy this watch or something like that. So I love being in this industry. I love being able to do what I do because I feel very deeply and passionately about it. But once my professional cap is sort of on, it's more sort of like talking about it from like as data driven a way as I can. So just in that context, then I think the reason we focus on the secondary market is that the main reason is that it's a big part of the watch industry. So I think there's this like sort of general trend that's gone on in the last few years, and we've certainly contributed to it, where watches have been financialized. And so it's, you know, watches are talked about as financial assets or commodities, or people talk about investing in watches, which, I mean, we have issues with that term, but I think it's come from a realization that the secondary market is large. The secondary market for watches is growing. And the secondary market for watches is not something that is taboo or stigmatized in some way that perhaps it might have been in the past. The way I like to think about it is, for as long as there have been watches, there have been watch collectors. As long as there have been collectors, there has been a community. And as long as there has been a community, there has been buying and selling between collectors. So then the question is not, should you be buying and selling watches that supposedly you're buying as like family heirlooms or whatever? It's the fact that when things have to be bought and sold, you need to know what the valuation for those items is. And so the impetus for creating the company, which Charles, the founder, created back in 2019, was literally just, it started out as a spreadsheet because he wanted to keep track of prices for the watches that he was interested in buying. And we still remain very mission driven in trying to build a service that can drive greater transparency into the secondary market and provide the kind of service that we wish we had when we started collecting watches. So why focus then on the secondary market in some sort of perhaps like more general or broader sense in the watch industry context? One is that the market itself is, by at least some estimates, at least, if not more than half as large as the primary market, just in terms of total annual transaction value globally. And it's expected that it will grow faster than the primary market over the coming decade. When exactly it overtakes it in size is obviously, that would require a crystal ball. So that's not a question that can be answered easily. But, it is increasingly a larger part of the watch buying and selling experience. CPO, or certified pre-owned, is a part of that. There are brands, smaller brands, that have always sort of been in that space. But now Rolex, which is, by production volume, one of the largest brands in the world, has, of course, started doing CPO. So it's interesting to keep an eye on the secondary market for that. And then lastly, secondary market values have something to say about brand equity and brand desirability. So the better your values hold, the better your watches hold value on the secondary market, the more that tells you about how desirable that brand is seen to be. If your watches on average are trading above retail, that tells you your watches are very desirable. If not, then perhaps they're not quite as desirable. Or when I say desirable, I mean just in terms of like pure demand in the market relative to the available supply.
So you touched on a really important point, and I want to dig into that just a little bit, which is around secondary value and how it correlates to desirability. And one thing I often wonder about this, and would love to hear your point of view, is if certain brands tend to perform better on the secondary market, and then other brands which might be more niche but be horologically interesting perform worse. Does looking at the secondary market create almost a perverse incentive to not take creative risk, both as a brand and as a collector? And I'm curious, and I mean, obviously it's a very personal thing, but it's an important question because we hear this often when we talk about independent watches in general, which is like, oh man, I would buy that, but like, I'm going to take a bath on the secondary market. And to me, like, that's a really interesting observation because on the one hand, that's perfectly reasonable. If I spend $50,000 on something and that becomes $30,000 when after I buy it, just bought a car, right? That's part of what goes into a purchase. On the other hand, I often wonder if there isn't something coded in that phrase and that statement about whether somebody feels confident that they're making the right choice creatively or, any number of other factors. So I'm curious to know your point of view of, other than a binary perspective of like watch worth more good, watch worth less bad, how somebody should think about the secondary data and how it should inform a decision outside of financial implication.
Right. So the first thing I would say to that is the vast majority of watches tend to end up trading at discounts over their retail prices once they're out in the world. So if you've bought a watch and it's lost value, you're actually in the majority, if that makes you feel any better. The second is that if you're thinking about it in terms of, and this is, I think, maybe where we can talk a little bit about what I said about like, we take issue with watches being thought of as investments. I think investment in its actual technical sense is perhaps different from the way people think about that word when they use it in the context of watch collecting. An investment is an allocation of capital that generates some sort of return, which means that if you're investing in a stock, then you're doing so with the expectation that it will give you some return over some period of time into the future. If that's your aim, with your capital allocation than just buy, index funds. Because over the long term, even vintage Rolex does not beat the S&P 500. We've done this analysis, like it just doesn't. You could have bought a 1675 from whatever 30, 40 years ago, and had you held on to it, and it was a new old stock condition, box and papers, receipt, everything, and had you allocated the same amount of money to the S&P 500, you would have actually have made more of a return on S&P 500. So I think when people talk about investing in watches, they're not necessarily thinking about that. They're more thinking along the lines of what you described, where like, I don't want to take a haircut on something. If I buy something, I want to know that I can get away with like not losing too much money or maybe making a little bit of money on this watch. And that's where I think as a collector, my take on it is I'm not doing this necessarily to make or to lose money. I'm recognizing that there is a cost to indulging in my enthusiasm for these objects. Luxury watches today have no inherent utility. Nobody needs them. They exist because there are enough people around the world who have been sort of hoodwinked into believing that these objects are fun to interact with or, collect or what have you, like all of the crazy reasons that we collect and the psychology around collecting. And there's enough of that demand and enough of a demand for conspicuous consumption that, these companies, these watchmaking companies can continue to exist and sell a product that is as much of a dream as it is a product. So if that's really what you're after, then again, it shouldn't matter whether the watch that you've purchased holds on to its value or not. Like the reason I buy a spring drive watch on the primary market is because obviously like I have a little bit of a thing about like wanting my name on the box and papers. If I didn't care about that, then maybe I would just buy pre-owned and let somebody else sort of pay for the depreciation. But the reason I'm interested in a Grand Seiko spring drive watch in the first place is because of how beautiful the sweeping seconds hand motion looks and what it tells me about my own lived experience of time and how it relates to, the experience of being a conscious entity. Like that's very different from saying, okay, like if I buy this watch, am I going to lose 40 cents on the dollar when I go to sell it? If I decide to sell it a year from now, 2 years from now, 5 years from now. So it really, I think this is sort of like a more nuanced take perhaps on the take that says, buy what you love. This is basically me saying, yeah, you should do that. And yes, like people's finances are a consideration in that. And maybe you shouldn't buy watches you don't think like you can afford to lose money on. But if you are going to buy a watch, then be prepared for that possibility and think about whether you think you're going to be okay with doing that. For me, on a personal level, for some of my purchases, I have that. I'm like okay with, losing money if I ever decide to get out of the watch. But at the same time, like if I owned it for a year, 2 years, like I wore it and I got a ton of enjoyment and fulfillment out of wearing that watch. And I don't know that I can put a price on that.
It's funny. Asher and I have had that conversation many, many times. And that's absolutely how we feel about it. Like, first of all, just this is a hobby. We don't view it as an investment at all. Frankly, I think it'd be foolish to view watches as an investment. And the data around vintage Rolex is really interesting. Didn't realize that. But I think more than just buying what you love, that's easy to say. But I do understand, just to play devil's advocate, the perspective from some collectors. And I think this is what you're saying, which is if I'm going into a purchase of a new watch, whether it's a new watch or a pre-owned watch, but a new watch to me, I do want to have some sense of where this watch leaves me and where it leaves my options in the future. Because, and Asher, you and I have talked about this many times, most often the reason someone sells a watch and moves out of it is to buy another watch.
Absolutely.
And so it's totally reasonable to say, I'm really considering this watch here, watch A. I kind of want to know what it kind of might be worth if I need to sell it, because I may need to sell it or I may choose to sell it to buy another watch. So I think it's very easy to say buy what you love, but I do like the way you described it. And it shows that it's more nuanced than that. Now, I think one question then for all of us is, look, today is Monday, July 29th. That is the date of this recording. This podcast will air a little bit later, but I think it's important to just call out when we're recording this, because I want to talk a little bit about the state of the current watch market. And I think rather than getting into too much data, and Watch Charts does a great job. You can go to watchcharts.com. You can get ongoing updates and great insights. Their YouTube channel is awesome as well. Check that out. So if anyone who wants to dive into that data certainly can. But I think more broadly, it might help to ground this conversation in where is the secondary watch market right now. We just did a recording with Tony Trena about the state of the watch industry. And we talked mostly about new watch wholesale and to some extent retail sales as well. But the secondary market wasn't something we got into or get into too much. So I'd love to know where you see the market now and what interesting insights might you have about the state of the current market that people may not be aware of.
Sure. Shout out to Tony. The high level sort of the headlines, perhaps you can call it, are what for the last 2 years we've been publishing on a roughly quarterly basis in a report that Morgan Stanley publishes that relies on our data and analysis. And so I'll just run you through the headlines in that report, which cover the second half of 2024 and then maybe the first half of 2024 generally. The first headline is that we have now experienced the 9 consecutive quarter of decline. And that's for just the overall market, and then specifically for Rolex, Patek, and AP, which approximately make up about 2/3 of the secondary market. So obviously the declines started after the market peaked in March or April of 2022, depending on whether you're looking at the overall market or specific brands. And then since then, it's just been sort of like in a constant state of decline on a quarter-over-quarter basis. The pace of that decline has definitely changed over time. So more recently, that pace has slowed down compared to what it was in 2022 and 2023, but it has not stabilized. So we haven't hit an inflection point where we can say confidently prices are no longer falling. They have either stabilized and they've stabilized around some sort of steady value, or that we're seeing them appreciate again. That just hasn't been the case. The second is that we are not near that bottom yet. So we can maybe talk about this in a little bit more detail, but we do an analysis of the market fundamentals, and then based on analyzing a few different factors around inventory and how long that inventory sits around for and how quickly that inventory turns over, we estimate that prices have not yet hit rock bottom. We still have further declines to go through. And then the other thing I think that's interesting, that's starting to take a chunk maybe out of the supply side of things for Rolex specifically, is the growth of the Rolex Certified Pre-Owned program. What exactly that effect is not well quantified, but I think it's fair to say that there is something there. Just what exactly it is, I think there isn't sufficient data to really comment on that very, very concretely. But on a personal level, like I am very sort of bullish on how Rolex CPO is going to grow and where it's going to go. And, that's just a sort of fundamentally different sort of creature from both the primary and the secondary markets, because it's its own thing that Rolex ADs are getting into. But just at a high level then, yeah, market's still in decline and we don't know when that's going to stop. Waitlist times have gone down, so there's reduced speculation for Rolex watches specifically again. But I think that starts getting into maybe a little bit of the detail. So I'll stop there.
We talked briefly about this from a consumer standpoint. I want to flip this over from a brand standpoint. We conducted a survey with our audience, which we're going to do an episode on probably after Geneva Watch Days. We've crunched all that data. But one of the overriding themes that's pretty consistent, and now we can say it is at least empirical within the context of what we've got, is that watches are objectively too expensive from the perspective of the consumer. And when I say too expensive, I'm talking about the primary market. Now, there's a lot of conversation about how watches are. We have a whole episode about how watches are priced. If you haven't listened to that, you can go back and take a listen to that. But putting that aside for a moment, there's a feeling, right? So that the consumer feeling is, I don't know that I want to pay X for that. So one question I have for you is, when we look at a secondary market perspective, if you're a brand, how do you generally advise brands, or would you advise a brand to internalize some of this data? And how should the secondary market inform not brand equity, but product pricing? And I'll give you an example. When we think about, here, I'll call out a specific brand that I personally love, right? So Parmigiani Fleurier, absolutely magnificent watches. Folks I've met there are lovely. I've owned several great watches. they trade for extremely low percentages of their retail value, even whether that's fair or not, whatever. That's just true. So if you were Guido and you were the CEO of Parmigiani, how would you take this secondary data and what would you do with it? And how do you think it should inform long-term financial strategy for some of these brands, or should it not?
I think it boils down to maybe two essential factors. One is how you set retail prices, and then the second is how you generate demand for your products and desirability for your products in the overall market, so primary and secondary. Once a watch has been sold at retail, whatever market price on the secondary market you end up seeing for a watch is a reflection of just how many people want it. If Rolex makes, 1 million whatever watches a year, but 5 million people want them, then, there's a certain number of people who are willing to pay those prices, which just periodically is going to cause the prices to go up. If Parmigiani is making, I'm not familiar with their production numbers, but let's say they're making 10,000 watches a year, but there's only 5,000 people that actually want to buy them, then not only are they going to not be able to sell everything that they have on the secondary market, it's not a seller's market. It's a buyer's market. And so the buyer can just say, okay, I'll buy this from you for 40 cents on the dollar, and I'm going to make you feel like I'm doing you a favor when I do so. Right?
Yeah.
So it factors in both cases. Now maybe they make 10,000 watches and they can sell 10,000 watches a year, but then for the additional 4,000 watches that are trading on the secondary market at any given time, are there enough people that all of that inventory can keep turning over at a healthy clip? Right. And if the answer to that is there's just not enough demand out there, that these watches sit around for months and months and months, and an inventory is just accumulating over time, then what that tells you is that your brand is just not seen to be as desirable as a brand whose watches do not sit around for as long because people just don't want to buy them. And then, of course, just lastly, just to answer the second half of, or maybe the first half of your question about, retail prices specifically, there is maybe some connection between cost of goods sold and whatever it takes to run a successful business and the prices that you set at retail. But I think there's another component of it which is purely psychological, which is that you want your watches to be priced at a certain tier so that they are seen to be in a band competing with watches from other brands. You want to be seen as being a competitor to X, Y, and Z, not P, Q, and R. So that makes it so that maybe like on the primary market, you're able to get away with charging those prices and convince enough people to purchase them. But secondary market, where it's far likelier that it's a collector who's buying that piece than somebody who just doesn't know that much about watches, there's no way you're going to be able to convince that person that this watch is worth retail. There are enough people out there who are sort of well-versed in the buying and selling of watches from these smaller brands that over time they just know that paying retail is not worth it.
So funny that you mentioned that. I got a email earlier today, or I guess we did, Gabe, into the info address from a watch brand, which I had not heard of. And they were pitching us on picking them up. And it was admittedly a very handsome chronograph. And as I was looking at it, I was like, this looks interesting, but like, I don't, it's like a $2,000 to $3,000 chronograph in my mind. Like, we don't really have a market segment for that. And then I get to the end of the presentation deck, and the watch is actually 13,500 Swiss francs. And I was looking at it and I started laughing because it was exactly what you were just suggesting, that this brand in their mind had said, well, our brand, the one that we're creating, needs to sit between a Daytona and, a Speedmaster, regardless of whether or not the brand has the equity to do that or the product should command that price point. And, Gabe and I have sat in plenty of meetings with people who bust out a presentation that show you charts about where the product is supposed to fit. But what I find really fascinating about that, and when we take a step back, this is kind of what I was getting at, is that, and we said this on the pod before, most of these brands, they're not selling to consumers, they're selling to us, they're selling to dealers. So the knock-on effect of the brand's desirability often has like a 12 to 18 month delay to come back to actually impact the brand, right? If I go to Watches and Wonders and I place I'll make this up, I place $100,000 order with brand X, and that's it. I've committed to pay that. So they know they've sold $100,000 of their watches to me and Gabe. And then I go to the market and I try to sell them, and there's very little interest or demand, and I can't move them at that retail price. I'm now stuck with them, or other dealers who may be over leveraged may have to dump them into the gray market, which is a whole other conversation, which of course has a very negative impact, generally speaking. I'm broadly generalizing, but
Right.
generally speaking, on a brand. So I find this interesting because let's say I'm the CEO of whatever brand, and I'm looking at the data of the current secondary market, which, as you've pointed out, is in consistent decline and has not found its bottom. But I'm still pricing things at a certain point, despite the fact that my secondary values show no sign of finding a floor yet. My primary customer is paying bills that they committed to from a year ago. So I'm going to probably have to pay the piper in about 6 months. So this is interesting. This is something that I'm very curious to see how the market is going to handle it the next time we all get together, say at Geneva Watch Days. When we look at this sort of thing together, and we may see a watch that's presented, and it's where we look at it and we're like, this is just unrealistic. Like, the market just can't bear this. And that poses a really interesting challenge to a lot of watch brands, because I know a lot of people look at some of these watches and think that it's like Scrooge McDuck jumping into a giant pile of cash in his pool. But for a lot of these brands, putting aside Rolex, Patek, blah, 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 for a lot of independents in particular, where we deal with it, like, they're priced that way because that's what they need to be priced at in order to make a living.
Would you say Tudor, for example, is good value for money at retail?
Me personally? Absolutely. Yeah, totally.
Okay. Would it surprise you?
But the thing is, though, that's not fair, though. That's not a fair question, because you built into Tudor are so many layers of economy of scale and access to cash.
Right. Yes.
That's an unreasonable framework.
Right. But I think that the point that I was trying to get at is that, would it then surprise you to learn that every single Tudor watch, except for one right now, trades below retail, and in most cases well below retail? Right. So just because they trade below retail doesn't necessarily mean they're not good watches. You thought at retail they were good value for money. So on the secondary market, they're perhaps even more so. And yet nobody thinks Tudor is doing badly. Nobody thinks Tudor is not.
I think it's a matter of absolute cost. I think that it's not a logical thing. I think it's an emotional thing. So I'll give you an example. Let's say you have a $4,000 Tudor, right? And you go to the store and you buy that. It's a great watch. I don't know what a Pelagos cost now, but whatever, $4,000. You go out, you buy that. It's an awesome watch. You're done with it. You call up Collective and you're like, I want to trade that watch in. You're right. What are we going to offer you? Like, probably around $2,000 for it, something like that. And but the thing is, like, the difference in absolute value is a delta of $2,000. If I go out and I buy a $65,000 independent watch, and then I call up another dealer, I'm like, I want to trade it in. They're like, sure, we'd be happy to. That's $26,000.
Yeah.
Or $30,000.
Yeah.
Even though it's the same percentage, the absolute is so big.
Absolutely.
That I think that creates a very different feeling.
Yeah. So, well, something like that. Yeah. So I think that's where really it matters a lot more, perhaps, for that independent that, in this case, Mr. Tereni is going out and generating demand and desirability for his product, and making it so that if you buy a watch from him and from his company, that you're not going to end up in that sort of a situation where you are forced to take a haircut if for whatever reason you decide you want to sell it.
We've talked a lot about price here. I mean, that's what we've almost spent the last 10 minutes or so chatting about is price as a metric. But that's not the only thing that you guys look at. So, Hamza, one of the things you mentioned, I think earlier, was absorption rate. Like, how long does it take for inventory to turn over? And, like I said at the beginning, we're users of watch charts, and price is certainly helpful to us because we buy, consign, trade on pre-owned watches. And so we kind of need to know what their valuation is before we can make someone a trade offer, a cash offer, things like that. But price is just one of the things we look at. We definitely look at days supply, or how much inventory is out there, because that also gives us a sense of how long we'll need to plan to sit on this thing. And B, if we don't want to sit on it for as long as the average watch takes to turn, what we would need to therefore price it at to make it compelling and have it move. Because, of course, cash flow is the oxygen of any business, but particularly a capital intensive one like being a watch retailer. So for us, looking at sort of supply of inventory is really, really helpful. Beyond price, what do you think some of the most interesting and telling measures are that you guys look at? Because I think everyone is out there, whether they're dealers or folks on forums or on Reddit or whatever talking about price. But that only tells part of the story. So I think from your perspective right now, what are some of the other measures that are interesting and that people should maybe be paying attention to?
So for people generally, I think what we publish on the website for each model is what we call a risk score. And that's a programmatic way of assessing the risk, as it were, of acquiring a watch at a given price and then assessing whether that price could go up or down. And that's based on levels of inventory. That's based on whether that watch has performed better or worse than other watches in the same collection, other watches in the same brand, and then other watches in its general category, however you want to define that. And then I think when we do market analysis that sort of digs even deeper into our data, not necessarily for the sake of communicating to the end user on the website how they should understand, market dynamics around a given watch, but when we're doing it for the Morgan Stanley reports or otherwise, like when we're trying to speak with dealers or brands, I think it boils down to the things that you've already mentioned. So days on market and the level of supply. So days on market is different from average age of inventory. It's just which segment you're looking at. If you're looking at sold inventory, then you care about days on market, which is basically how long did it sit around before it's sold. And age of inventory is for all of the currently active listings, how long have they been sitting around? Total supply is just total supply. So that's, existing supply plus new listings minus sold listings. That's that month's number. And then that number changes over time. And then the absorption rate is a ratio of how much is selling relative to how much is listed at any given time. So the higher the number, then that basically tells you that the inventory for that brand is turning over more frequently. The lower the number, or if it's even in the negative range, then that tells you that inventory is building up. And that's going to cause downward pressure on prices. So across these three factors, I think looking at them in combination will tell you whether the market is in a quote unquote healthy place or not. If absorption rates are good, your inventory is not building up, so total supply is not increasing, and then your average age of inventory is not rising, then that tells you that there's no mispriced inventory that's sitting around on the market. One example of that's sort of trivial to make is you can go to any online marketplace today for watches and you'll find Rolex Daytona's 116500s, so the previous generation ceramic bezel Daytona, listed for over $35,000, in some cases even north of $40,000, right? Oh, it's a complete set from 2022 with box and papers and it's never been worn and da-da-da. Sure, maybe. But even the premium for that sort of condition does not justify that price tag. And likelier than not, that listing has been sitting around for months and months, maybe even years at this point, because the seller is unwilling to take the haircut on that watch that they have to take to be able to move that inventory. So in terms of market health, what that means is like the more that there's inventory like this that's just sitting around, that means even if demand doesn't change over time, right? There's a certain number of people that come into the market every day to buy. They're not buying enough for this sort of inventory to get sort of taken off the market. And that's essentially where we are today. And that makes us say, sure, like prices are going down, but we're not like just sort of eyeballing it and saying, okay, like prices have fallen to 3-year lows or near 3-year lows. And so that seems like it's sufficient for market prices to stop falling, right? They're going to come back in line with where they would have been had we not experienced the crazy spike of 2022, and they're keeping pace with inflation, and they're just going to sort of like keep going into a upper right trajectory. That's not a given. And in fact, that's not what we've seen over the last 2+ years at this point. So we do look at these other factors to determine whether prices are going to stabilize or not. And what these factors tell us right now is that prices have not stabilized.
Presumably then, let's say, because I think this is really interesting. Let's say there's still let's take the example of the previous generation ceramic Daytona. So let's say your data suggests that historically there's a larger number of these than usual that's on the market. That suggests to you, regardless of the stability of the price, whether it's continuing to drop or go up, but just the sheer amount that there are more of those out there that aren't clearing the market, suggests to you that the price has still some room to decline because presumably the people who are listing those watches do want to sell them.
Right.
Otherwise they wouldn't be on the market. They do want to sell them, but the market is unwilling to accept the price at which they're being offered. And therefore, in order for those watches to turn over, the price would need to decline. Is that kind of the dynamic you're seeing there?
Yeah. Think about the imagine a customer who is more price sensitive than anyone else out there, right? Now, what that customer could literally do is...
Oh, I can imagine that customer.
I feel like I'm stepping into your world, and you probably see more of those than I can imagine. But that customer literally could, if they wanted to, if they really cared about price above all else, go out and contact 20 different dealers who have 116500s listed for sale, because there are that many, and say, okay, you all have the same watch, more or less. They're all from the same year of production. They all come with box and papers. And I'm getting this guy to give me, $100 less than what you're charging, but he can't deliver before Friday. So I know you can deliver before Friday, but I'll go with you if you can let me off this $100, right? And that's, on the secondary market, margins are not as good as they are on the primary market. So that $100 represents a far larger proportion of your margin on that sale. And this customer could literally go through this exercise and squeeze every last penny of savings out of a potential purchase that they could get away with, which is very different from the same customer trying to buy a Daytona in December 2021. They would not have been able to get 20 dealers to give them time of day if that approach is what they decided to walk into the market with, right? So it's just a different dynamic at this stage, and the fact that prices are declining and the fact that there is this much supply available is what allows that type of customer to get away with doing, that sort of strategy on buying a watch at the best price possible. Does that answer your question?
That totally answers the question. I think one of the things I noticed in the quarterly report you guys released with Morgan Stanley was Rolex, Patek, and AP. You guys call them the big three because they're sort of, as you mentioned, they make up the majority of the pre-owned market.
About 2/3.
So that's why they're the big three. They have been in the last few years sort of the poster children for the decline in secondary watch values. In some cases, their values have fallen the most, and they were, of course, emblematic as well, conversely, of the peak in the bubble of the watch market in 2020, 2021. And so we've seen those prices unwind dramatically. One of the things that you guys explained, which I thought was really interesting, is those three brands, Rolex, AP, and Patek, have actually moved recently from being the worst performers in terms of price decline to the middle of the pack. So they're no longer the worst. They're kind of right in the middle. But at the same time, the inventory for those brands, and this is relative to 2021 levels, has exploded on the secondary market. What does that tell us? And do these watches just turn more quickly? Is there just some more active market for these brands that can absorb more of their inventory than other brands? Or is something going on? Like, how has the inventory on the secondary market for these brands built up so dramatically? Yet it seems like the rate of decline in prices is slowing.
Right. That's a very interesting question to answer. Of course, we know that supply has built up because once the market started to fall, every speculator out there who was like, oh, I'm going to hold on to this watch because it's going to appreciate forever, was suddenly panicking and saying, oh, I should get out of this, right? We've all heard stories of people who, because they got allocations with their ADs, every year, like clockwork, bought one or two stainless steel Rolex sports models and just put them away in the safe as a quote unquote investment, right? And then when the market started to fall, a lot of these people started dumping these watches onto the secondary market, to the extent that today, if you look at our Rolex index, which is the 30 most popularly traded watch models for Rolex by transaction value, the supply for those watches has built up. So there are more of those watches available today, and they include your usual suspect professional model, sports model Rolex watches in both non-precious metals, so steel and titanium, the Yachtmaster 42, and as well as several precious metal Daytonas and subs and what have you. And then, of course, there's Datejusts and Explorers and other watches. But the supply for these watches has built up. Now, if we were just looking at total supply, we would say, okay, like that's bad because more supply there is, even if demand doesn't go up, that's going to put downward pressure on prices. But we're also looking at absorption rate. And absorption rate is where, there hasn't been a drastic decrease in absorption rate. So perhaps to some degree, because of that, the downward pressure on prices is buffeted, even though total supply is building up. And then lastly, obviously, age of inventory. So that, again, for Rolex, because it's been going up, tells us that there's a downward pressure. But all of this presupposes that there is some perhaps like baseline level of available inventory in the market that represents a quote unquote healthy market, right? Where maybe prices aren't continuing to fall just nonstop, which is where we are right now. It's not really obvious whether there is such a baseline level of inventory for any brand. It's always just a dynamic between available supply and ready demand, and how those sort of two forces play out day after day, week after week, month after month in the market that determine, where prices are going to go. So perhaps earlier in 2022 and then into 2023, there was more of a state of panic where it wasn't really obvious where things were going to go. And so everybody was just immediately starting to dump stuff out. Now there's maybe less of that. And these people are also no longer buying up all of this available inventory. So the speculator has gone out of the market, which means more people that just want the watches are able to get them, or are sort of just slowly with time adjusting to the fact that, okay, like a Daytona is going to cost you north of $20,000, depending on whatever variant or generation you go for in a stainless steel model. And I just have to suck it up and be okay with that. For watch as desirable as a Daytona, I think that dynamic certainly still holds true. For your average Grand Seiko, perhaps less so.
Yeah. And I mean, look, a Daytona will always be an example of itself,
right?
For any number of reasons, not the least of which being that, as everyone knows, a Daytona is nobody's first watch from a dealer. So there's a sunk investment in cost. So buying secondary, ironically, is probably a much more affordable way, certainly a faster way to get your hands on one. But one thing that I've always thought was interesting about Rolex, and I'm curious how this impacts, or if you see it impacting anything, is that Rolex has always been very deliberate and walked their own path in terms of price increases on primary market. When you look at, say, Patek Philippe, for example, or the greatest, probably one of the greatest offenders, AP and Lange, their primary market pricing has just gone to the stratosphere. And the secondary market pricing is has largely returned to normal. I'm seeing Langes available on the market for now, like, traditional Langes, like Lange 1s, et cetera, Saxonia Thins, largely available for about what they were, trading for 4 or 5 years ago, give or take. But the primary market price is now twice that, as opposed to, a third greater. With Rolex, it's interesting. People are saying the sky is falling when they realize that they're Submariner trades for like retail plus tax, which is, as far as I'm concerned, comically good value retention, like insanely good value retention. So it's interesting. And I wonder if that's a fair thing to draw a correlation between, which is moderate price increases in the primary market mean or have an impact on rational pricing in the secondary market, or if Rolex continues to just be a case study of itself.
We were talking earlier about value for money, right? I'm curious if you would agree that Rolex at retail is excellent value for money.
On some references, yes.
On some references, okay. I mean, generally, I think if you're talking about a steel watch, that probably is the case. Precious metal, I think, becomes a little bit more dicey to argue that point. But the reason I mention that is because I think value for money essentially is just consumer perception, right? And so the consumer believes, rightly or wrongly, but the average consumer believes that a Rolex is worth what it costs at retail. And so the premium that you pay over that in terms of secondary market availability is, in some sense, like you said, paying for access or paying for the convenience of not having to go into your local AD and say, hey, can I buy this watch, and suffer the embarrassment of being turned down, or any number of other similar sort of like social factors. It's, again, like not necessarily a reflection of like intrinsic value or something. In that sense, I think, yes, like most other brands generally do tend to trade at a discount, and AP has certainly been trending in that direction, which at this point, of the biggest brands, I think leaves just Patek and Rolex, where a big chunk of their current production catalog, if not most of their current production catalog, or the majority of their current production catalog, trades above retail. So in that sense, it's not just Rolex that experiences that sort of like demand in the market. Patek, I think, is certainly also right there with them. And then you can't really compare those two brands because they're just such different product offerings, and they sit at different price points. They make a different number of watches. In that sense, perhaps Rolex is, in a category of one. But I think fundamentally then that's backed up by the product quality and the value for money trade-off that the average consumer believes they're getting when they purchase one.
So let's roll the clock back to 2018. Cartier, I'm looking at the Guardian here, so the source is giving me the price in GBP. But Cartier bought back 400 million pounds, so something like $700 million worth of watches, because at the time, Cartier's position in the market was nowhere near what it is right now, and primary market dealers were discounting the ever-loving heck out of the brand, and it was seriously devaluing the brand. So Richemont, the owner of Cartier, made an unusual and very rare decision to buy it all back, suck all the inventory out of the market, and as a result, probably took the first step towards what I'm sure Gabe is going to ask about Cartier. Before we get to that, though, I'm curious. That was an extremely bold and cash-intensive move, and if we believe absorption rate is a really important metric, then there is probably an argument, and this actually, let me rephrase that. Is there an argument that when a brand sees a delta over a prolonged period of time that is so dramatic between the retail sale price of a watch and the secondary market sale price, is there in your mind a time when they need to break the glass in case of emergency and buy it back?
I will plead humility on a question like that because I have not been in the watch industry for, relative to how long these companies have been around, or certainly a lot of people at these companies have been around. I've relatively not spent as much time, so far be it from me to tell them how to do their jobs better than I think they're doing it right now. That said, I think
somewhere in Switzerland, an angel just got its wings.
I don't know. I think I'm just always just personally very sort of conscious of the fact that, like, even with my interest as a collector and enthusiast, like I still have much to learn, and I will probably die having more out there to learn that I could have learned about watches and watchmaking and the watch industry in general. That's just me speaking as a collector. Than I will have learned, assuming I die at a ripe old age. But I think the point from a market standpoint or market analysis standpoint, certainly that is exactly what Cartier is trying to do. It is trying to change fundamentally, in some sense, the mismatched supply and demand situation. So they believe in that situation that it has become severely imbalanced. And that's not just reflected in secondary market prices. I think in that case, it's probably much more reflected in how much gray market inventory they're seeing for their watches. So it's not that, in 2018, suddenly, because there was all of this unsold inventory sitting around, that secondary market prices were crashing. And that's the metric that they were paying attention to and decided to use that as an input to making this buyback decision. I think it's probably more that they saw that their retailers were quietly getting rid of inventory on the secondary, on the gray market, and that would hurt brand equity, and that's what they wanted to combat. I think in the future, it's possible, certainly, given the state of the secondary market today. It just the watch market just generally seems to be very cyclical in terms of its dynamics overall. There could be brands that find themselves in that situation again soon, if they're not already talking about it internally. So for a brand like that, I think, yes, if you take a bunch of inventory out, if you basically fundamentally change the equation from the supply side, that is going to have an impact on prices. And maybe it's the sort of impact that you're looking for. So if you believe in that sense that, you need to do that to save your brand equity, then it's an understandable decision if a brand did that today in 2024, or maybe sometime next year in 2025.
It relates to something we talked about a couple of episodes ago, which is when there's simply too much supply. And you could say, and Hamza, I love your point about like, well, Cartier was probably more, and we're speculating here, interested in protecting the equity of their brand and primary market pricing and all that kind of stuff. But it does get back to too much supply. There was too much supply of watches. And so what dealers then had to do was turn around and essentially dump it onto the gray market. And the problems cascade from there. The value gets destroyed from there. When there's too much supply and value gets destroyed in that way, someone has to pay the bill. In our last pod, or a couple pods ago, we talked about Hodinkee having to pay the bill for Crown and Caliber having too much supply of watches that was dropping in value. And they have paid that bill by their investors, I'm sure, having to essentially take a write down on the valuation or their equity in the company. People have lost their jobs, no longer are able to make a living because of this. Someone has to pay the price. In this instance, Cartier or Richemont literally paid the price. They bought this stuff back. And I think it further underscores a theme we've talked about a lot on this podcast, which is this is a really tough industry. It's a very capital intensive industry. For most people listening, it's a hobby. And when the value goes down on their watch, like, well, that kind of stinks. Like the thing I have now is worth less. And if I decide I wanted to sell it or trade it or toward another watch, like it's worth less. And that's not great. But when this stuff happens within the watch industry, someone has to pay the price. And we're seeing that happen now in terms of brands and retailers having to pay the price of oversupply. I guess my question about Cartier now is we're in a different position with the brand. They did buy back inventory. Cartier is also on the primary market or on the new market having a moment. It's definitely a hot brand. Yet, one of the things I thought was really interesting in your report was their secondary market data shows that value retention for Cartier continues to decline in line with other Richemont brands. So their secondary market values are continuing to go down in line with brands like JLC and Longa specifically you called out. So I guess kind of like what's going on there? The perception, I think, for folks not digging into the data is this is a hot brand. It's doing well. It's never done better in recent memory. Yet when we look at the secondary market data, it tells us that its prices and values are declining on the second market in line with other Richemont brands who we know and may perceive as having declining value.
I think there's three sort of segments that I would draw attention to for Cartier. There is the vintage stuff, which I think is genuinely rare and has an interesting story around it that probably Eric Koo as a collector, not as a retailer, but Eric Koo as a collector can articulate far better than I can, right? And it's a story of design, of craftsmanship, of rarity, of something genuinely unique and magical in the history of mid-20th century watchmaking that really no other brand has. And so if you're going into the vintage market, there is a very special story there that Cartier can credibly tell, and that they deservedly get great prices at auction for. In my personal opinion, I think the more recent trend of neo-vintage and more modern pieces being hyped on the secondary market is just the latest trend or fad in watches. And that's really all that you need to understand to understand what's going on with Cartier. Back in the mid-2010s, like there was this phase where vintage Rolex was like the big thing. Everybody wanted, vintage Rolex, vintage UGs, and tri-compacts were hot. And then bubble backs were seeing crazy prices. And then all of a sudden, like bubble back prices crashed. And, they sort of like came back to earth. The next big trend that I would sort of propose after that took over was integrated bracelet sports watches. And the integrated bracelet sports watch, I think now is starting to give way to this trend of like small sized or oddly shaped watches as a way of like expressing my individuality and look at like how perhaps like hipsterish I am or whatever like the messaging is around that. And I think that's a space where Cartier, just because of the way that they have made watches historically, has excellent back catalog pieces that people can dive into and geek out about. and, really sort of get interest generated in. So how long that trend continues is unclear, and what would come after that. Is it perpetual calendars? Is it, dinner plate sized Panerais again at some point? Fashion is cyclical, but I'm sure Panerais will come back in vogue at some point. Who knows? And how long this trend sits around, like, who knows? So I think that it's exactly like you said, right? Like, Cartier is hot right now. And that's, I think, what the messaging around that is. But for modern watches, right? Like, I think the second you peek behind the curtain a little bit, like, even a current production Panther in full gold, right? It's $20,000+ watch. You can just go to Cartier's website, click add to bag, and you'll have it before the end of the week, right? Now, that's an excellent customer service experience, because, like, you wanted something and it was available for you to purchase the second you wanted it. But what that also means is that supply just doesn't match demand. These watches are not sold out at retail, and there's not people clamoring for them the way people are clamoring for a Moonswatch or a GMT Master or a Daytona. And so if you're going to want to buy one of these watches on the secondary market, it's going to, unfortunately, sell at retail. Maybe stuff like the backwards running Red Santos, right, could be a collector's item in 20 to 40 years. Like, who knows, right? But just like a normal Panther or a drive to Cartier, like I bought a drive to Cartier extra flat in steel a few years ago when it first came out. And I bought it online. And I'm sure if I decided to try and sell it today, I would get pennies on the dollar. But, again, like, that's not why I purchased the watch. Like, I'm never selling that one. But I think that explains, again, it's just a question of supply and demand. That's what explains why modern Cartier value retention is not comparable to Rolex or Patek. They just make so many watches that they're easy to find relative to how many people want them.
It's so funny that you mentioned that relative to Cartier. In January of this year, I bought a beautiful Cartier from Watches and Wonders of last year, which was a one shot. So for those who don't know, it's something that they produce for 1 year. And I ordered it from my AD, who's great. And he called them up. They told him it was the last one. I was very excited. I bought it. And then I found out from one of our clients that he walked into a Cartier boutique, and guess what? They had the last one. Wild. Which says two things to me. That's not a dig on my AD, to be very clear. What it tells me is that the power of the Cartier brand is strong enough that was a motivating incentive for me to think, oh, if I can't get it now, I can't get it later. And it didn't really matter to me in the end because I wanted the watch. I didn't buy it because it was the last one. It was just, it's what ended up pushing me over the edge. But it does say something about Cartier's brand equity today that works. But it also proves your point of, like, it's not the last one. And that there's plenty there. But Gabe and I talk a lot about the idea of luxury as access, which we touched on earlier in the episode. And to a certain degree, it doesn't really matter if it's the last one, because I was able to get it. And being able to get it is in and of itself luxurious.
We've also talked a bit about this notion that sometimes the watches that receive the most attention or critical acclaim or love and positive feedback and praise aren't necessarily the most commercial. Mm-hmm. And it's important to separate that out. So while Cartier, and again, this is speculation, while Cartier may be having a moment as a brand whose designs are in vogue and all that, that may be very different from the commercial reality of people who are actually going out to buy them.
100%.
The only thing I would say is, again, this is on a personal note, because the market has been declining for most of the time in which we have been reporting on it in a serious way, there's this it's hard to describe. I feel like I wish I had better news to share that would make people feel good about being into watches, rather than telling you that watch you purchased is now worth less than it was, when you bought it. But we, do the best we can on reporting the data that we see and that we collect. And so, unfortunately, right now, the message happens to be that the market is in a state of decline. I would love to be in a place where I can tell you that the market is actually in an in an upward trajectory, the secondary market. And so that watch that you held on to all these years is finally starting to appreciate, and maybe you won't lose as much money on it as you might have had you sold at the bottom of the market, but we're not there yet. And just on a personal level, that, I would like to be able to get back to that place, because I also think when we do, where we started this discussion was talking about the financialization of watches, right? I think a lot of the pressure to talk about the financialization of watches for the average collector will recede. This will not be what's front and center of mind for people, how much my watches cost and how much I'm losing on them. And I think that's fundamentally a healthier place for collectors to be in, where they can talk about watches and they can talk about, they can argue over date windows and chronographs and perpetual calendars, as opposed to arguing about, well, I bought this and you bought that, and like, you're going to save more money than I did when we both decide to sell our watches. So, I made the wrong choice and you made the right choice, and that says something about you as a person. Yeah, I'm really looking forward to that day.
We agree. And thank you, Hamza, for joining us. We appreciate you massively. Thank you for listening. Openwork is a production of Collective Horology, and you can find us online at collectivehorology.com. You can also find our guest, Hamza Masood, at watchcharts.com. And while this episode is not sponsored, we are huge fans of Watch Charts as professionals and consumers and fully endorse their offering. So check it out when you have a chance. To get in touch with suggestions, feedback, or questions, email us at podcast@collectivehorology.com.